welcome to KiwaniTalk. We're a public information show put together by people from the Dearborn Kiwanis Club with help from students and faculty at WDHS at Dearborn High School. My name is Gary Gardner, your host of the longest running cable access television program in the entire universe, KiwaniTalk. Today we're talking about something that's been around almost as long as KiwaniTalk, and it's something that people don't like to face. It usually happens every April 15th. But there's more to taxes than just April 15th. It's a thing that you need to think about throughout the entire year. And as you approach the ripe old age, as I am, of getting retirement down the road, but you're looking at assets you have, pensions, 401ks, required minimum distributions, all those types of things. Sounds yucky, but we've got a guy here who's going to help us out, who's going to help you enjoy it, love it, and learn how to live with it. Jerry Assenmacher. Jerry, welcome to the show.
Hi, Gary. Good to be here.
Good to see you. Jerry, you are now the CPA Senior Tax Advisor of Tax Solutions Center, LLC.
Yeah. About a year and a half ago, January 1st of 22, I sold my practice, Assenmacher and Associates, to another company in anticipation of the day when I retire. So I sold the practice to them. I made an additional 5-year commitment to continue to basically manage the practice that was once mine. And I'm still in the same location I've always been for about the last 10 years. I'm on Monroe Street off Otter Drive in Dearborn, 2350 Monroe, the Dearborn Area Board of Realtors building.
So it sounds like you're like me, you're down to half days now, just 9 to 9.
No, I'm still working as many hours as I've ever worked, if not more, because the problem we have right now in our industry is as we tax preparers get older, there are not new ones coming in at the other end. So we seem to be taking on more and more additional clients on a yearly basis.
So tax preparation, now there's all these things. There's the TurboTax, and the federal government, IRS, has things you can do online. And I'm sure there's a place and a taxpayer for those types of programs. Talk about that real quickly so we get on to the people who need your types of services.
Well, so yeah, there are all those free type of services that are out there, but they're usually very limited on what you're allowed to do. I know with TurboTax, I believe if all you've got is a W-2, then TurboTax will allow you to do the return for free. But what you got to be careful with that sometimes is they may give you the federal return for free, but then they're going to charge you for the state of Michigan, because you still got to file a Michigan tax return as well. The IRS has been developing an online free type of service as well. But again, it's usually for somebody who's got a very simple return, whether it's a senior who may have just a pension and maybe a 1099 interest from a bank and Social Security. But once you get into things like accounts with financial advisors, when you get those complex 1099s that are detailing all of your stock dividends, your interest, your stock sales, and things like that, most of those programs, though they might be able to accommodate what you want to do, you might be the problem in trying to make sure that you enter it correctly.
There's the axiom is that when someone says, I'm from the government and I'm here to help you, you want to flee as quickly as you can and find someone who knows what the heck they're doing.
Well, and the other problem is when you do your return on something like that, TurboTax, or you're doing your return yourself, the problem you have is that if you make a mistake and you get a letter from the IRS where they're not only going to ask you for additional tax dollars, but they're going to ask for penalties and interest, writing back to them and saying, I didn't know what I did wrong is not an excuse. You're still responsible, and you're still going to get hit with the penalties and interest, which sometimes could add up.
But I heard that now with the revisions to the tax law that it's so simple. I can fill out my tax return on a postcard
Yeah.
and not have to worry about it. So I don't need the TurboTax or the IRS system or the Quicken Loans or whatever QuickBooks things.
Well, we're now back to 2 pages on the 1040, which was where we were always at. And now, in addition to that, we have 3 schedules, Schedule 1, 2, and 3, where you accumulate all that data. That just never happened.
Never happened. So that was the Full Employment of Tax Professionals Act of 2017, I guess.
Yeah, well, all it did was it made us relearn how and where to put numbers on your for your tax return.
And something you mentioned kind of in passing is that if I do my own returns, which I haven't done for years because mine turns out to be about 70 pages deep between my office and my home and everything else, and I had rentals for a while and all those sort of things. I have no idea what the heck I'm doing, and so if I was to make a mistake, again, I don't have the excuse, but if I have a tax professional who may have a reason for what they did, it wasn't a mistake, they can point out the IRS's mistake to the IRS or explain why they did what they did rather than just taking the hit and paying the penalty.
Yeah, so if I do someone's tax return, there's a box on page 2 of the tax return that I check all the time that says that the taxpayer, by signing their return at the bottom, is also giving me permission to talk to the IRS directly regarding that return. Now, what I unfortunately found out the hard way just, in fact, a few weeks ago is that's only good for 1 year. So a year after the return, if there is still an issue that the IRS has discovered after 1 year of filing that tax return, then what I have to do is I will have the client sign a power of attorney form, Form 2883, I think it is. I'm going blank on the number. But that form, they'll sign and they'll basically tell the IRS, it says, hey, you can talk to me about their tax situation. And I 100% do not want my clients talking directly with the IRS.
Same as I don't like my clients talking to the police.
Right, exactly. I know the lingo. I know when you have to tell them something and when you don't have to tell them something. Everybody seems to get in front of the IRS and they want to tell them everything. Well, just answer the question. And in your business, you know that as well. Just whatever they ask you, you answer that. You don't give them anything more than that. And that form allows me to talk to the IRS. And the IRS they want to work with you. Anybody who believes the IRS is out to get you, if they are, there's a reason why they're out to get you. But the average Joe out there is, the IRS wants to work to resolve whatever the issue might be.
So if someone wants to come and to hire the services of Tax Solutions Center, what kind of person would be your typical client that would need to come or should come, and people who actually do it? What's your typical?
So the typical client that will come to me generally will have either W-2 or a pension, depending again on their age, or in some cases will have both. They may have Social Security income. They may have rental properties. One or both, if they're married filing jointly, one or both may have a small business on the side, so there could be a Schedule C involved. If I didn't mention it, rental properties, which involves filing another schedule, Schedule E on the rental properties. The other big one is that if they have investments, and I'm not talking about investments in their 401k, I'm talking about investments outside of a retirement account. Because those investments, for instance, let's use Merrill Lynch as our example. If they have money invested in Merrill Lynch, oftentimes if it's enough money they're investing, they may have 1, 2, I've seen as many as 4 or 5 different 1099. They call them combined 1099 statements. And those statements are going to detail all of their tax transactions in that year, whether it be dividends, whether it be interest, whether it be capital gains for stocks sold. And in some cases, like dividends, some of those dividends may be taxed at capital gain rates. So you got to know that, where to look for that information. The other one could also mean, this is something that's been brand new that came under the tax law changes under President Trump, is they have what they call 199A sales or dividends. And those are subject to 20% of it not even being taxable. Every year it becomes more and more complex with that. So if you're getting one of those type of statements, and I've seen some of those statements be as much as 150 pages in length, you probably shouldn't be trying to do it yourself.
The cost for doing something like that of your own and the risk versus the cost, I'm not going to ask for prices, we're not here to shop prices, but the cost of having it
which
done,
are going up, by the way,
having it done
like everything else in this world.
Having the tax preparation done properly, and the peace of mind that you get is well worth the cost in putting it out there.
Yeah, and I'm going to stand behind anything that that I do. If there was a mistake made, the first thing we want to find out is is it a piece of information that the client didn't give me? Maybe they didn't realize they didn't. And that's where the nice thing is that if you come back year to year, people's information doesn't change much from year to year. So you might not even know that you're supposed to be looking for a 1099 from Charles Schwab. And you'll bring your information in and I'll say, where's the 1099 from Charles Schwab? You're going to sit there and say, oh, I didn't get it yet. Well, we know we got to wait now to finish the return. Or you might tell me that the account was so small, I closed it last year. So I'm going to be able to ask questions in that case.
So there's some things that you want to get to. Jerry has a lengthy list of being the accountant and detail person that he is. Let's try we've got 3 minutes for the break. Let's go through a few of these.
Okay, so in our last 3 minutes, let's talk about IRAs, because that seems to be a big thing, especially right now. Right around the time that this is broadcasting, we're going to be getting right down to the end of when you should have been taking your required minimum distribution. Now, anybody who has an IRA understands what a required minimum distribution is, or
they should.
Or they should.
Yeah.
Yes, but the issue you have is that number one is if it's the first year that you have to take a required minimum distribution, or you might not know exactly how much you should be you're supposed to be taking, but you really want to try to take at least have it in place, ready to go by December 1st. So in this case, December 1st, 2023, you're going to want to make sure that it's set up to be taken out. The penalties for not taking your required minimum distribution are 50% of what you didn't take. So for instance, if you had an RMD, required minimum distribution, if you had an RMD of $10,000 and you only took $5,000 out, your penalty is 50% of $5,000 or $2,500. By the way, that's another reason to hire me, because I will at least attempt to go to the IRS and say, hey, we discovered it in February of 2024, and we took it out immediately, and we're putting it on the tax return because we know we were supposed to take it. I've had very good luck with that. The IRS has never asked for the 50% penalty on anything like that.
But if you have an IRA, should you not have perhaps a financial advisor who's helping you through that,
Yes.
separate from your CPA?
Yes.
And if they haven't told you to do it or given you an idea what you should be doing and what you should do with that advisor, never mind. I'm not going to go down that road.
Well, but you make a good point. Oftentimes I'll have clients call me and say, how much am I supposed to be taking out of my IRA? Call your financial advisor.
Right.
They have all the calculations. Can I do the calculation? Absolutely. I'm not going to bore you with how that calculation is figured out, but they've got all the information. In fact, they even issue you a form in May of the year you have to take that distribution, and they'll tell you what that distribution is. The thing you have to be careful of is that if you have multiple IRAs with multiple financial advisors, because you've got to take, you don't have to take your RMD or your requirement of distribution. You don't have to take it from every single IRA, but whatever that is for all of them combined, you must take out of at least one or a couple of those IRAs.
We're getting to the exciting part now.
Yeah.
Before we get back to the exciting part, we're going to take a break, come back with Jerry Assenmacher, Senior Tax Advisor, CPA from Tax Solutions Center, LLC. Don't go away. Jerry's list, you got the whole list. We got to get through a lot more of it, Jerry. Don't go away. Welcome back to KiwaniTalk. I'm your host, Gary Gardner, for this episode talking about taxes. And for your information, the last time I took a tax class was when I was in law school. It was the summer of 1978, and I know things have changed a lot since then. That's why I don't do my own taxes. I hired people like Jerry who helped me through it and have kept me pretty much out of IRS prison for all these years. So that's a good thing. Jerry, welcome back.
Thanks.
Senior Tax Advisor, CPA of Tax Solutions Center, LLC. We were talking about IRAs, but there's something else you need to talk about.
Yeah, just to wrap up the IRA thing. What we're seeing more and more is inherited IRAs. For instance, your parents pass away and you inherit an IRA from your parents. This is not ones that if a spouse passes away and the other spouse inherits it, they can just flow it into their own IRA. But once the second spouse has died and it's now going down to the next generation, to the kids, the rules changed a few years ago on these inherited IRAs. You used to be able to take them out over your lifetime now. Now you must take them all out within 10 years. So if you have a $100,000 IRA that you inherited from your father, you've got to take that out over a period of time of 10 years. The law was originally interpreted to say you just had to take it out over 10 years. So some people were not taking any out in year one, nothing out in year two, and they were trying to, I don't want to say manipulate it, but depending on their income sources, they wanted to put it into other years. The IRS has changed the rules, and starting in 2023, you must still take some required minimum distribution, which your financial advisor will tell you what that is. But the other rule that you've got to take it out within 10 years is still in place. So what I've told my clients in most cases is, unless there's a reason to take more or less, you at least have to take that required minimum distribution that the financial advisor tells you. But I tell people, take the amount, divide it by 10, and take 1/10 out every year. Now it's going to grow, hopefully, so maybe in year 10 you might have to take a little bit more out. But the important thing is that I want to just leave with everybody is inherited IRAs from anybody other than your spouse. And there are a few other rules that I haven't come across in this case. But for the most part, any IRA other than from your spouse must be taken out within 10 years. And that includes Ross.
Wow.
Okay?
Okay.
All right, I wanted to switch a little bit up and talk about two significant changes that are happening here in the state of Michigan. Last year, and you might have read about this in the newspaper about a year ago, we had a surplus, believe it or not, for the state of Michigan. And our higher ups in Lansing, their idea was they did not want to mess with the tax rate in the state of Michigan, which is 4.25%, was to 4.25%. We have a flat tax in Michigan. So they were going to give every household a $180 rebate to get rid of this surplus, because there was something in the Michigan law, Constitution, that basically said that if there was a surplus, they had to drop the rate for taxes in the following year. So they thought by giving this $180 rebate to everybody, they wouldn't have to drop the rate. Michigan Supreme Court, I think it was Michigan Supreme Court, shot it down. They said, no, the law said the rate's got to go down. So you never got your $180. I didn't get it. I'm assuming you didn't get yours either. You shouldn't have. But the change is the tax rate for 2023 in the state of Michigan, instead of being 4.25%, is 4.05%. So that means for every $1,000 of income, you're saving $20 in taxes. 0.2%.
Whoop, whoop, and
Yeah.
whoop.
Yeah.
Okay.
Yeah.
There you go.
The more significant change that happened, Governor Whitmer, back in March, I believe it was March 7th of 23, signed a law to change the taxability of pensions in Michigan for seniors. Under Governor Snyder, we changed the law, I don't remember how many years ago. They changed the law, and they went away from basically a standard amount that's allowed to be deducted for what you receive for IRAs, pensions, 401ks, and all of that. So really what was happening is the younger you were, the less you got to deduct. So between now and the year 2026, they are going to phase back in what I'll call the old rules. And so for 2023, if you're single, $56,691 of your IRA pensions and 401ks, and $113,922 if you're married filing jointly of your retirement will be deducted, will be allowed to be deducted. But that
What do you mean by be deducted?
You won't have to, you pay federal income tax on it, but you're not going to pay state of Michigan tax on it.
Michigan income tax free.
Right, it's going to become Michigan tax. Now, if you were born before 1946, so 1945 and before, that law is in place. You're getting it right away. For some people, that didn't change because they were grandfathered. Where it's going to affect people is those that were born 1946 through 1958. It's going to be, you're only going to get 25% of that amount. So if you're married filing jointly, 25%, you're only going to get 25% of $113,000, which would be, I'm going to guess, around $38,000. And then it's going to be phased in. Next year, in 24, you'll get 50%. And then in the next year, you'll get 75. In 2026, you'll get the whole 100%.
Okay.
All right. So it's going to be a good deal. By 2026, we'll be back to the old laws.
Back to good old days.
The good old days. The good old days before it was switched. The other thing I wanted to talk about a little bit is, and I see this in my practice a lot, I have clients coming in. Mainly, these are some of my older clients, and older is relative to you and I.
It's changing all the time.
Yes.
Older's getting younger.
So they will come in, and they're still stuck in the old ways of coming in with all of their charitable contributions, all of their tax statements, and and even bringing in their medical information, and their mortgage statement as well, if they have a mortgage. About 7 years ago, that law changed, and the standard deduction back then for a married filing joint individual was only about $12,000. It's now changed this year for a married filing jointly. That number is $27,700. That is what you get to take off of your taxable income. That's the standard deduction. And if you're a senior citizen, 65 or older, you get an additional $1,500. So if you're over 65, married filing jointly, your spouse is 65 older, you get over $30,000. You only get to deduct $10,000 for taxes. So now that $30,000 is down to $20,000. If you're 65 years old or older, most likely you don't have a pension any longer. I'm sorry, you don't have a mortgage any longer. So there's no mortgage interest to deduct. All you really have left to deduct is charitable. So if you're not giving away $20,000 to charity, you're taking the standard deduction, because you always want to take the higher of your actual deductions or your standard deduction. So keeping track of all of that is just not worth it anymore.
What you're saying, Jerry, is that you have to have boatload of deductions and the effort of tracking, as we do, is that we go to Salvation Army or the Goodwill, we dump off some clothes or some furniture, or some household items, get a little receipt, and that is not much. Sheila, you got to pay attention to this guy here, okay? That's my wife.
Yeah. I mean, I'll be honest with you. I keep track of all my charitable donations every year. But part of the reason I keep track of them every year is because I want to remember next year who were my charities that I was giving money to and all that. But I don't have a mortgage on my house. I have only been able to itemize once since this tax law changed, as many as 7 years ago. And that was only because I did something called bunching my charitable contributions. And that was where I prepaid, the next year's charitable in the beginning year.
Jerry, we're down to our last minute. Okay. Believe it or not, all the excitement about the taxes and Jerry's big list, and he was excited and geeked before the show.
I only got to half of it.
I only got to half of it. We need to do a second show so we can come back and do the second part. What's the most important thing people should remember about getting taxes and preparation and planning?
The most important thing is get your stuff in as early as possible to your preparer. The tax season has now gotten down to where it's February 15th, even March 15th to April 15th. So get the stuff early to your preparer. If you don't have everything, get what you have to them. They're gonna be able to work on it in January and early February, and then when you get that last piece, they're gonna be able to finish it up real quick.
Okay, so people are curious where they can find Tax Solutions Center LLC. What's the phone number?
The phone number is 313-277-5800.
And the website?
Well, my particular one is jerry.a@rwsgroup.org.
And that's going to be right here on the screen. How about that?
Okay, perfect.
Jerry Assenmacher, CPA, professional, bon vivant. Thank you for coming on the show. I appreciate your time.
Great,
Good
Gary.
to see you again.
Good to see you.
Good to see you on KiwaniTalk. Get your tax stuff done early, but don't worry about all the little minutia because it doesn't matter anymore. Gary Gardner, see you next time. Bye-bye.